Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far 23 problems I have completed on CVP analysis. In this video I'm going to start from 24th problem. Few more problems I'm going to explain you, so watch the video till the end. All the problems are based on the formulae and the concepts. Without understanding the concepts and formulae, you cannot be able to understand at this situation. So if you have not watched the earlier videos, please go to the playlist of my channel. Select the subject Financial Decision Making 2. Select the videos of CVP analysis. Be perfect, be clear regarding all the concepts of contribution, PV ratio, break-even point, margin of safety, etc. Then only you can be able to understand. Now, before starting the 24th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of the points which I have written, then I'll explain every problem in detail. Now, 24th problem. Given margin of safety 20,000, which represent 20% of sales. That means this MOS 20,000, which is 20% of sales. We don't know how much are the sales. So by using this relationship, we can find out the sales. And PV ratio 50%. Find out break-even sales, fixed cost, and profit. Easy problem, simple problem. So first of all, MOS, margin of safety, is given 20,000 and which represents 20% of sales. PV ratio 50%, we have to find out BEP, fixed cost and profit. Now see, when MOS is 20% of sales, means if sales are 100, then MOS will be 20. Because according to this percentage, for every 100 rupees of sales, 20 rupees is the MOS. So I'm making here, when sales are 100, margin of safety will be 20%, right? But what is the actual MOS here? The actual MOS is 20,000. So when MOS is 20,000, how much would be the sales? So we can find out 20,000 divided by 20 into 100. You will get 1 lakh. That means the sales are rupees 1 lakh. We have calculated. Now, MOS. The formula for MOS is actual sales minus break-even sales. So MOS is given in the problem 20,000. So in place of MOS 20,000, actual sales, just now we have calculated 1 lakh. So actual sales 1 lakh minus break-even sales. Equation has been formed. Now take this break-even sales to LHS. So this minus will become plus. And bring this 20,000 to RHS, it will become minus 20,000. So 1 lakh minus 20,000 is 80,000. So finally we got break-even point is equal to 80,000. First question we got it. Next we have to find out the fixed cost. For calculating the fixed cost, we can use the BEP formula. The break-even point is equal to fixed cost by PV ratio. By using this, we can find out the fixed cost. The break-even point, already we got it 20,000 here. In place of BEP, I am writing 20,000. Fixed cost we don't have, but PV ratio is given in the problem 50%. 50% means 0.5. Now cross multiply F into 1. F, 80,000 into 0.5 is 40,000. We got the fixed cost. So we got the break-even point, we got the fixed cost. Finally, we need profit. The formula for MOS is profit by PV ratio. Two formulas are there. One formula, actual sales minus break-even sales. Second formula is profit by PV ratio. Any formula you can apply. Now I am applying this formula, profit by PV ratio, because I need profit. So MOS is 20,000. Profit we have to find out. PV ratio is given 50%, 0.5. Now cross multiply, P is equal to 20,000 into 0.5, 10,000. So we got the profit 10,000. That's all. Only the thing is, you have to remember the formula. And remember, you have to practice. After having all these problems, you have to practice yourself. After watching this video, you got clearly the procedure, the steps involved in finding out. then you do it yourself. Next, 25th problem. An analysis of Sultan Manufacturing Company Limited led the following information. The variable cost, percentage of sales and fixed cost. The direct material is 32.8% of sales. There is no fixed cost. Direct labor 28.4% of sales, no fixed cost. Then factory overhead is 12.6% of sales and fixed factory overhead 1,89,900. Next is distribution overhead 4.1% of sales and rupees 58,400 fixed. And lastly, general administration overhead 1.1% of sales and 66,700 fixed. So we have fixed overheads, factory overheads, fixed overhead, distribution and general administration. We combine all fixed overhead and take the total fixed cost. Budgeted sales are 18,50,000. You are required to determine break-even sales value, that means rupees, BEP in rupees. Profit at the budgeted sales value. At this sales of 18,50,000, how much we can get the profit? Profit if actual sales drop by 10% or increase by 5% from budgeted sales. So these are the things we have to find out. First of all, we want the total fixed cost. We have fixed cost under factory fixed overheads, administration fixed overheads and distribution fixed overheads. So here total fixed cost 1,89,900 plus 58,400 plus 66,700. 3,15,000 is the total fixed cost. Now variable cost as a percentage of sales. All the percentages are given. Material is 32.8% of sales and labor is 28.4% of sales. Like that, all percentages are given. We can add up all the percentages. It will become 79%. So simply we can say variable cost is 79% of sales. Right? Now budgeted sales. Budgeted sales value is 18,50,000. These are the expected or budgeted sales. Now variable cost is 79% of sales. So 79% of 18,50,000, it comes to 14,61,500. So we got the variable cost. The fixed cost 3,15,000, variable cost 14,61,500 and sales value is 18,50,000. First question. What is the break-even sales, BEP in rupees? So I can conveniently apply this formula F into S by S minus V because every information I have. Fixed cost 3,15,000. Sales 18,50,000. Sales 18,50,000 minus variable cost 14,61,500. Numerator keep it as it is 315 into 18,50,000. Denominator you subtract 18,50,000 minus 14,61,500. 388,500 is the denominator. Now directly you cannot multiply 3,15,000 into 18,50,000. It will be a huge number. So what we will do? The shortcut method. 3,15,000 divided by 3,88,500. First you divide, then multiply by 18,50,000. You will get 15 lakh. This is the break-even point, BEP. First question completed. Now it is asking you what is the profit at the budgeted sales. So profit at the budgeted sales. Sales are 18,50,000 and the variable cost is 14,61,500. So sales minus variable cost will get the contribution 3,88,500. From contribution subtract the fixed cost. Fixed cost 3,15,000. We'll get the profit 73,500. So 73,500 is the profit at the present budgeted sales. Over. Now last question is, what is the profit? Profit is how much if actual sales drop by 10%. If the actual sales is dropped by 10% from the budgeted sales. How much are the budgeted sales? 18,50,000. So from 18,50,000 deduct 10%. 10% comes to 1,85,000. So from 18,50,000 minus 1,85,000, you will get 16,65,000. These are the actual sales. So sales 16,65,000 and variable cost is 79% of sales. The variable cost is 79% of sales. So 79% of 16,65,000, 13, 15, 350. Subtract sales minus variable cost, will get the contribution 3,49,650. From that, deduct fixed cost 3,15,000, we'll get the profit 34,650. So 34,650 is the profit if the actual sales are 10% less, right? Last, if actual sales are increased by 10%, we have to find out what is the profit if actual sales increased by 5%. So 18,50,000 into 5%, whatever you get, add up, you will get 19,42,500. After adding up 5%, you will get 19,42,500. So sales 19,42,500 minus variable cost. 79% of 19,42,500, you will get 15,34,575. Subtract, will get contribution 4,07,925. The fixed cost will remain same whether sales have increased or sales have decreased, because the fixed cost remain constant. 3,15,000 subtract, will get profit 92,925. So this profit will get if the actual sales are 5% more than budgeted sales. That's it. This is the problem number 25. Now, 26th problem. Two businesses, X Limited and Y Limited, manufacture and sell the same type of product in the same type of market. So two competitors are there, X Limited and Y Limited. The budgeted profit and loss account for the coming year are sales. X Limited sales 30,000, Y Limited sales 30,000. Variable cost, X Limited 24,000, Y Limited 20,000. Fixed cost, X Limited 3,000, Y Limited 7,000. The total cost, variable cost plus fixed cost, total cost is 27,000 for X Limited and 27,000 for Y Limited. Sales minus total cost will get the profit. The profit is 3,000 for X Limited, 3,000 for Y Limited. So what is the difference between these two companies? The sales are same, profit is same, total cost is same. Then what is the difference? The difference regarding the composition of fixed cost and variable cost. In X Limited, variable cost is more and fixed variable cost is less in Y Limited. Whereas fixed cost is less in X Limited and fixed cost is more in Y Limited. That is the difference. Now, required, calculate the BP and MOS of the two businesses. For each business, we have to calculate the break-even point and margin of safety. That is the first question. Second question, state which business is likely to earn greater profits in conditions of heavy demand of the product and in conditions of low demand of the product. That means which company's profitability is more if the demand is high in the market or if the demand is low in the market. Which company is better? The second question we'll discuss later. First question, calculate the BEP and MOS of each business. Easily we can find out. Marginal cost statement will make two columns, X Limited and Y Limited. Sales, 30,000 sales for both the companies. So 30,000, 30,000. Sales minus variable cost. The variable cost is different. For X Limited it is 24,000 and Y Limited it is 20,000. So sales minus variable cost, 30 minus 24, 6,000 and 30 minus 20, 10,000. Contribution, 6,000, 10,000. Minus fixed cost. The fixed cost is 3,000 for X Limited and 7,000 for Y Limited given in the problem. Subtract. So 3,000 profit for both. This is the information given. Now first we calculate PV ratio. PV ratio is equal to C by S into 100. Contribution by sales into 100. We have the contribution here. 6,000 by 30,000 into 100. You will get 20%. PV ratio 20% for X Limited. Similarly, PV ratio of Y Limited. Contribution is 10,000. 10,000 by 30,000 into 100. 33.33%. So we got the PV ratio of X Limited 20%, Y Limited 33.33%. Now easily we can find out BEP. Break-even point is equal to fixed cost by PV ratio. The fixed cost is 3,000. So 3,000 divided by 0.2. 20% or 0.2 means same. So 3,000 divided by 0.2, you'll get 15,000. So break-even point 15,000 for X Limited. Similarly, come to Y Limited. The fixed cost is 7,000. 7,000 divided by 0.3333 because 33.33%. So divide 33.33 divided by 100. You will get 0.333333 like that. So 7,000 by 0.3333 you will get 21,000. So break even point is 15,000 for X Limited and 21,000 for Y Limited. Now finally MOS. It is asking you margin of safety. Actual sales minus break even sales. So actual sales are 30,000 and break even sales are 15,000. So 30,000 minus 15,000 is 15,000. Now Y Limited actual sales 30,000 and break even sales 21,000. So 30,000 minus 21,000, 9,000. So we have calculated the BEP and MOS of both the companies. Now last question, last bit is, which company will earn more if the demand is heavy in the market? High demand in the market. Heavy demand in the market. Now you remember, if the demand is high in the market, that company will earn greater profits whose PV ratio is more. Higher the PV ratio, more is the profit. So in our problem, the PV ratio is 20% and 33.33%. So which company is having more PV ratio? Y Limited. So in case of heavy demand in the market, then what will happen? Y Limited is going to earn huge profit because its PV ratio is more. Lastly, low demand in the market. If the demand in the market is declining or low demand, that company's profitability will be more whose BEP is less. The break-even point is less, that company is better. So in this case, the BEP is 15,000 and 21,000. So which company BEP is less? X company. So if the market demand is falling, declining, low demand, then X Limited is going to earn greater profits because its BEP is less. X company will start getting the profit after 15,000. Whereas Y Limited has to wait till it attains 21,000. After 21,000 it will get the profit. Before 21,000 it will incur loss. So X Limited will be better. After 15,000 itself it will start getting profit. So market low demand, X Limited is better. Market high demand, Y Limited is better because PV ratio is high. That's what you have to give the explanation. So these problems are very, very important from examination point of view. These are decision making problems. So far we have completed 26 problems in CVP analysis. The next problem will continue in the next video. So if you are satisfied, give a like to the video. Share my channel among your friends, among your groups, so that more students can watch the video and enhance the knowledge. Give your comments and subscribe my channel if you have not yet subscribed. By the super thanks which is given below my video. Inshallah, we will continue the next problem in the next video.